Now, if you're like most average people, you hear about inflation, you hear about rising interest rates, but sometimes it doesn't compute. Maybe you generally know why rising interest rates tend to be bad for the economy and tend to be bad for jobs, but maybe you don't know exactly the reason for it. So in this video today, we're going to talk about it, and stick around to the end, because by the end of this video, you should understand why rising interest rates are bad for the average citizen and when we can probably look for these things to kind of ease up. Before we get into that, of course, I want to remind you guys that YouTube and the algorithm, it's still around. It still does its thing, and it still looks at videos, especially if you're like me and you haven't put up a video on the channel for a while. So help out the YouTube algorithm and help out the channel by hitting the like button, the subscribe button, and you might as well hit the notification bell as well, so you are notified when I have new videos here on the channel. I promise they won't be as long as this stretch between this one and the next one as there was with this one. But enough of that for now. Let's talk about interest rates, and for the average person, understanding why rising interest rates is not good. Now, if you don't know anything about interest rates, or you think you kind of know but don't really know, let's go over just the basic understanding of them. Interest rates is the cost of borrowing money. So obviously, if interest rates are lower, it costs you less money to borrow money. And this affects things like how much you have to pay back on your credit card, how much you have to pay back for car loans, how much you have to pay back for home loans. In fact, the rising interest rates have put the home ownership market in kind of this weird flux, as well as the rental market, as things are really expensive now, because it's going to cost you an arm and a leg to finance a house. Like if you financed a house that was $250,000 5 to 10 years ago, it would cost you a lot less than it would be to buy the same house, or the same house for the same price today. Now, if you are working class, if you're even somewhat in the middle class, and especially if you are younger, people just getting out of college, because it's more expensive now to borrow money and it's more riskier for banks to loan money to people, it is also putting a dent in home ownership, especially again for young people. It's almost impossible, even with making $60,000, $70,000 a year, which, not that long ago would have been enough for you to have a fairly decent house. And now we see a return of a lot of people saying, hey, it's probably better for me to rent. I don't have to spend as much money on it, et cetera, et cetera, et cetera. But the one thing renters will always miss out on that homeowners have is the equity. You're not taking money and just giving it to somebody else to perform a service. You're actually putting money back into something that you own. And that gives you a lot more leverage in the future, whereas you don't have that kind of leverage if you're just renting. Now, this can usually be offset, obviously, if you're somebody who, like myself, who bought a house back in the early to mid 2010s, you have probably some of the lowest interest rates of the last couple decades. And if you have a fixed mortgage rate like I do, you're locked into that. So it doesn't matter if the interest rates go up so much to my mortgage payment. It does matter in other things, and we'll get to that in a second. But because of that, I don't really have to worry about my percentage going up. But again, anybody new buying a home, it's a problem. Now, this doesn't apply to credit cards. So if you have credit cards, and you guys know I'm an advocate of credit card churning, I'm also advocate and said in a lot of prior videos, so make sure you pay the credit card off by the end of the month. Don't spend any more than what you usually would be making, because the whole point is to just buy it with the card and then pay it back with the same money you would have used anyway if you didn't have the credit card, just to get the points and stuff. This takes a little bit of a turn when you have high interest rates. Number one, a lot of the credit card companies are not going to be offering some of these bonuses that they were for signing up with the credit cards. Issuing credit cards is going to be a little bit more stringent. You might not be able to qualify for some of the higher tier cards, whereas maybe a couple years ago you could. But the biggest thing is the interest rates on the payments. If you have something on the card and you let it kind of go overboard for one, you're like, $100. If I have a balance of $100 and it goes in the next month, not such a big deal. However, if the interest rates are going up, you're paying, let's say, $28 just to have that $100 left over, and that's $28 out the windows. The amount of money that you have to pay back on any kind of credit card debt you have goes higher, and that can be a really big problem, especially if you're very high in credit card debt, like a lot of Americans apparently have been since the pandemic ended. Now, probably something that's a benefit in some ways is you have to look at savings banks. Now, in one sense, if you have some money saved up, the value of that money is a little bit lower because of rising interest rates. But here's the thing. Banks, when the interest rates go up, they also tend to raise the interest they're giving on things, in particular savings accounts and checking accounts. When I first really started looking into financial independence and financial security and financial education many years ago, there was a bank called Immigrant Direct that was online, and this is when Ally Bank and a lot of those kind of online banks became popular. And one of the things that set them apart at that point in time was they were able to offer some ridiculous rates, and we're entering that phase again 2-3 years ago. A lot of these banks, even Ally Bank, it was like maybe 1%, 1.25%, 1.5% if you were lucky from having one of these savings accounts. Now a lot of these places, from American Express, Immigrant Direct, and so on and so forth, Capital One, they're offering 3.5%, 4%, 4.5% compound interest on putting your money in a bank. So if you're a person who's looking at your stock portfolio and you're going, well, I'm used to getting 4%, but now I've dropped a little bit, it might be an idea to kind of park that money in a savings interest account that's getting 4.5% compounded monthly, and kind of take your chances there if you're not doing that well in some of your other investments, or if you're with a bank that's not paying you that much. It is a good time to go shopping for possibly moving your money somewhere else. That's one of the few benefits that you can get from interest rates going up. Now, for those of us who are investing in the stock market, you do see swings, and we're seeing a lot this year. It's been this year and last year have been some of the craziest years of the stock market, because especially the last couple of months, it's been taking very wild swings. A lot of people have had to readjust their strategy, because what worked 6 months ago is not going to work today, when the market could be up $3 one day, down $10 the next day, down $20 the next day, but then it goes back up again another $5, $6, $7, $8. These are exaggerations, but it takes these giant swings, and it's very hard if you're investing, especially if you're an options trader, to kind of gauge where things are going, because it may look like the market's going up for the next 3 days, and then you get a day where it's like, nope. And a lot of world events, as we know, there are a lot of very tragic events happening in the world right now, especially over in Asia and Europe, that are affecting the stock market and affecting the world in general. But as far as stocks are concerned and your investments are concerned, those big events that happen around the world do play into this. And on top of rising inflation, and on top of the interest rates being used to fight that inflation, it has been a wild roller coaster ride for anybody who's investing in the stock market. Now, don't get too doom and gloom about this, because as with everything, these come in cycles. As I mentioned before, back when I first started looking into really understanding how money worked back in 2006, 2007, there was a bank called Immigrant Direct. And at the time, they were able to offer high interest rates because the interest rates were kind of high back then. Then we went into a point of low money, which everybody took advantage of. That's why everybody started investing and hopping onto Robinhood and Bitcoin and buying cars and doing all this kind of crazy stuff. There was this big point in time where it was very cheap to borrow money. And now that the interest rates have risen, there's an old saying that you'll see when the tide goes out how many people weren't wearing clothes when they were swimming. And you're starting to see that now. Actually, we've already been seeing it for almost a year now. And what that really means is there are people that operate on margin, they operate on leverage, and they over leverage themselves. They borrow too much money. And now that the tide has kind of gone out as far as the interest rates are concerned, and now everything's more expensive, they're getting caught holding the bag, because now they have to pay back a lot more than they did before. But as I mentioned before, there are other opportunities. There are opportunities for you to do reverse indexes if you're into investing. And maybe since the S&P 500 may be going down, there are other stocks that go up. There's some options trades that you could do if you're an options trader, obviously taking advantage of a market that's in decline. And as I mentioned with the savings banks, there's a lot of places out there that are offering interest. You can also look into the bond market. That's also a place to look at to get some big returns on your money over the next year or two, while we're still dealing with this recession, while we're trying to fight inflation, and while these interest rates are very, very high. But overall, it's usually not a good thing for the market. That's not to mention the job loss and the stress that it's causing a lot of Americans. Now, in my personal life, I'm not buying any big, major, expensive things. I was thinking about trying to buy another house over the next couple of years. But with the interest rates the way they are now, and the fact that the interest rate I have on the house I currently live in is so low, it wouldn't make any sense for me to sell the house that I have to buy a even a house the same size, maybe even a little bit smaller than the house I have, I would have to pay more money monthly in my mortgage than to just stay where I am right now, which is a place a lot of homeowners find themselves in. So there's good and bad to everything. It's up to us to kind of look and see where we can find the good spots when a lot of things are bad. There's always opportunity when things are in turmoil. But that's just my opinion. I want to know what you guys think about this. Let your voice be heard in the comment box below. And until next time, stay tuned for more videos here on Wrestling with Finance, the YouTube channel for people who have struggled with finance in the past and look to do better with it in the future. I'll see you guys here for more videos. Be safe out there.